it's told that it was a 15-minute break. So it's 15 Brazilian minutes. It's okay for me. All right, let me just put that off. All right, so let's come back to the modeling part of the talk. So as I told you, we're going to look at dynamics which have this kind of shape, right? And the nice thing that we can see from this kind of stuff is that when you look at the price dynamics, so the vector of prices, SK1, SK2, SKN, it's actually a Markov chain, right? When you look at that, especially if well, in the case where the ZK plus one are IID, right? So it's a Markov chain. So what's nice with Markov chains is that there's a lot of theoretical tools that we can use, right, for Markov chains. I'm not going to use that much here, and I'm not going to discuss too much about Markov chains here, at least on the theoretical part. What's also nice is that they're very easy to simulate, right? And simulations of Markov chain is kind of something which has been studied a lot and implemented a lot. So we're going to look at a certain number of simulations as an example, right? So let's look at an example of a market where you have two assets, right, and one fund. So it's one big fund, right? And those two assets have a fundamental correlation which is equal to 0. Right? So once again, that means that this matrix, capital sigma, so the fundamental covariance matrix, is a diagonal matrix. Right? So that's actually the case of a fund which would invest in assets that it believes are uncorrelated. Right? That's kind of an ideal situation for a fund, right? They try to look for this kind of investment opportunities, so kind to find uncorrelated assets or uncorrelated strategies. Right? So asset 1 has a volatility of 30%, asset 2 has a volatility of 20%, and the fund has a certain size in each asset. So alpha 1, so the size of the fund's position compared to the first asset's liquidity is 10%. So it means that the fund holds 10% of the market depth of asset 1, right? That's the holdings, and same thing in asset 2, right? And as we were discussing, we're looking at a fund who's going to be subject to deleveraging or fire sales in case things go bad, right? So here, if the fund loses more than 5%, it's going to slowly deleverage according to this kind of function. Right? Here is just an example, but you can kind of input any kind of favorite deleveraging schedule. Right? So I'm just using one which is arbitrary. We'll see how it works in the general case. Right? So what does it give us? So we simulate that, right? So this is a very simple market, right? So you have two independent assets. They behave as kind of, let's say, Black-Scholes, one with a volatility of 20%, the other one with a volatility of 30%. And you look at the fund, and the fund has a certain fund value, right, which is the sum of its position in this asset. And if the fund value loses more than 5%, the fund will deleverage a little bit. But by deleveraging, it's going to impact the asset prices. Right? What we assume here is that the fund deleverages proportionally. So if the rule of deleveraging here tells the fund to liquidate, let's say here, 40%, the fund is going to liquidate 40% in asset 1 and 40% in asset 2. Right? That's the rule that we follow here in the simulations. We can also change this kind of rules, but that's the one we follow here. Right? If we look at that, and if we plot the realized correlation distribution, right, we have this kind of graph. So here in green, so we do 100,000 simulations, right? And in each simulation, we calculate the realized correlation between the two assets. Right? And as a comparison, in each simulation, we look at the market which would not be modified by the feedback effect. So we look at a parallel price dynamics, which would be the same as this one, but without those terms. Right? So we compare the realized correlation in the full model and the model which would be only the fundamentals. The model which is only the fundamentals, we know what it's going to give us, right? The realized correlation should be close to 0. It's actually what we get from this curve in green. You see that realized correlations, so without feedback, are centered around the value of 0, right? And they seem to be equally centered above and below this value, right? So it means that in certain scenario, it's a bit above 0. In certain scenario, it's a bit below. And very often, it's close to 0. Right? But in blue, we have the realized correlation for the real market, which is the market where you have those assets which may be modified by the fact that the fund deleverages. And what we see is something which is very interesting, is the fact that here you have a fat tail in the distribution of realized correlations. So you see that the realized correlation between the two assets, so asset 1 and asset 2, which is supposed to be equal to 0, or at least the fundamental realized correlation should be 0, we see that on average it's actually much more than 0. Right? And it's actually shifted to the right-hand side. When do those things occur? It's actually those scenarios with. So what does that tell us? That tells us that there are significantly more scenarios with large correlations in the model with feedback than without feedback. And actually, if you look at conditional realized correlation, it's even more pronounced. So here, you have the distribution of the realized correlation conditional on the fact that the fund started to deleverage. So it's conditional on the fact that the fund lost more than 5% at one point. Right? And you see that the fat tail is even more pronounced. So here you see that although the fund kind of seems to have done a good diversifying job by finding two uncorrelated assets, the fact that it has to behave in a certain manner in bad scenarios is actually going to make those diversification effects disappear. It's precisely when things go bad, so when the fund loses more than 5%, that the two assets in the portfolio are going to behave in the same manner. So that's actually caused not by anyone else than the fund. It's the fund's own behavior that is actually generating this fat tail. And it's the case for the fund. Of course, it's bad for the fund. It's also bad for any other investor who is holding one of those two assets. Suddenly, an external investor who is involved in one of those two assets will see the asset prices decline and will see the volatility of those assets increase. So there is a contagion effect from the guy who is deleveraging to other people in the market. Right? So that's something which is actually inconsistent with the Black and Scholes model types and all those kinds of stuff, which shows that actually the correlations that you observe depend on what happened in the market. So they are path dependent. They are strongly path dependent. In scenarios where the fund didn't have to deleverage, everything works in the correct manner and correlations are approximately 0. But in the bad scenarios, so when the fund lost more than 5%, and once again, here 5% are completely arbitrary, right? It's for the simulations. Well, it's in those specific cases that correlations are actually much higher than the 0 that we were expecting. And the irony is that it's actually in those scenarios that you need the diversification effects the most. Right? And in those precise scenarios, that's when it fails. Right? So that comes from simulation results, right? So we could still argue that it's just linked to the choice of parameters, right? And the choice of this function f and everything. So what we're going to do now is look at the continuous time limit of the discrete time framework that I've just presented, right? So it's an approach that we liked a lot with Rama because if we just look at discrete time, we have a lot of intuition and simulation results, right? the ones that I just exposed. And this is just a few simulation results, but you can actually simulation, you can do as much as you want, right? So you have a lot of insight coming from intuitive modeling and simulation results, right? But there will always be a doubt as to whether the results that you get are linked to a particular choice of parameters. Right? If you start directly from a continuous time model, you will have a lot of tractability, right? But it seems kind of arbitrary to just start with a given continuous time model, right? Except if it's a simple one like Black-Scholes, right? But if you want to start with a complex continuous time model, it's actually pretty hard to justify the shape of the continuous time model. So the strategy that we followed with Rama was to say, okay, discrete time models give a lot of intuition, right? Everything that I exposed here, and especially this kind of behavior here, seems pretty intuitive, right? You have one movement and 1 second movement, so that's something which is pretty intuitive. That gives a lot of intuition in simulation results. So now what we're going to do is to look at whether this discrete time dynamics has a limit when the time step goes to 0 to a continuous time dynamics. That would actually justify the shape of the continuous time dynamics and would give us all the tools which are linked to continuous time dynamics and especially a lot of tractability, right? So the basis of this kind of proofs comes from convergence theorems. So maybe just to recall, we are going to, well, first all the paths that we're looking are Cadillac, so right continuous and with a left-hand side limit, right? And we are going to look at weak convergence of those Cadillac processes. So what's weak convergence? It means that for all functions g, oh yeah, it's a g here, so it's a g here and here, which are continuous and bounded, and which are defined on the, which are, and yes. The Cadillac process, which is indexed by this time step delta t, converges in expected value as delta t goes to 0 to the expected value of the limit, right? So that's the definition of the weak convergence, right? That we say, we also call that convergence in law, right? All right, so that's what we want to show, and here the capital XT would be the process of prices, so on our setting we call that S, right? And the delta t is here actually our time step during the trading day, right? The trading time step. So I told you it's a day, but it's actually arbitrary, right? So what we're going to do is just that we're going to look at this discrete time model and make the period of trading go to 0 and look at what it gives us, right? And what it gives us in terms of weak convergence, right? So we're going to use a theorem, which is well, there's a lot of ways to prove that. I'm using, we use the theorem from Etier and Kurtz, which is a very generic theorem and pretty strong theorem, which tells you that to show this kind of convergence theorems, you have to look at 3 different lemmas, or actually 4 different lemmas, which are the following. First, you make sure that the probability that the price increment is larger than a certain, conditional price increment is larger than a certain value epsilon goes to 0 at a certain pace, right? So faster than delta t, right? You make sure that the expected value of the increment converges to the right drift, and the expected value of this kind of covariance converges to the right covariance matrix. And that's actually plain calculation theorems, right? It's not super complicated. It's just a bit technical, but not like fundamentally complicated, right? And once you follow those 3 lemmas, so lemma 4, 5, and 6, right? You look at the SDE, which is given by this drift B and this covariance matrix A. And if this SDE has a unique strong solution, then you have a convergence, which is a weak convergence, right? So it seems maybe technical, but it's not that technical. It's just you start with your discrete time dynamics. You verify a few lemmas. So this one, another one on the drift, another one on the volatility, right, or covariance, and then you verify that the limiting diffusion that you are looking at, so with a certain drift and a certain covariance that you already found, is well posed, right? So it has a unique strong solution. If that's verified, your discrete time dynamics converges to the SDE with parameters B as a drift and A as a covariance matrix, right? Yeah? No, there's no jumps. So actually, so that's a very good point. This here ensures that there's going to be no jumps. Yes, exactly. So in the end, we're going to have a limit which is an SDE. Right? So let me show you the limit, and I'm going to come back to this remark by Stéphane. So in our framework, the limiting process would be the following. So under some assumptions here, which are here actually, on the smoothness of the liquidation functions, right? The discrete time process converges weakly to the SDE, which is this SDE here, with a drift mu and a volatility sigma, where the drift mu is given here, and the volatility sigma is given here. Right? So one interesting point to come back to Stéphane's remark, here, when you look at the new parameters of, so you see here, all the terms in red here, they are actually linked to the feedback effects. Right? If there were no feedback effects, the drift should be M. It's the drift that I input, like in the Black-Scholes drift. And the volatility should be A, which is a square root of the covariance matrix sigma. But because we incorporate potential feedback effects, there are terms in red. Right? And one surprising feature is that it could be that there are jumps, but actually just for a technical reason, we forbid jumps. But if you look at those terms, so Stéphane, those factors, F prime and F prime prime, can be extreme. Right? So we could allow in a kind of a manipulated manner for hidden jumps in the sense that those parameters can be very large. Right? And especially if you look at the first derivative of the function f, as I told you, is something which looks like that, typically. So that can be very large. Right? So although we are in a model where the limit is continuous, we can kind of still allow for some extreme behavior. Of course, it's not jumps, but it's going to be through extreme parameters of the diffusion. Right? All right. Yes?
Don't you need any control of the third moment to get the convergence?
No. So no. We just need two. So Max's question is about the third moments. So here, I just check about the first. It's the second. No, that's all. That's all. There's no control at all. Yeah. But there's something additional, is that the problem is well posed here, right? It's not just that, right? You have to have you have to have this, plus that the martingale problem associated to this drift and volatility is well posed, right? So typically, if A and B are Lipschitz, it's fine, right? All right. So one thing now, if you look at the limit, the limiting process, right? So that's the limiting process. You see that it's actually not that straightforward, right? So you see that it would be very disputable if anyone came up with the dynamics, which would be this one, without having introduced the discrete time model. Right? If someone wants to model feedback effects or systematic trading effects and says, okay, I'm starting directly with a continuous time model and the drift is this and the volatility is this, first question is why? Why is that so? Because you lose all intuition here, right? It's already lost, right? But we didn't do that, right? We started from a discrete time model where the intuition was pretty clear, right? you saw how everything reacted period by period. And by looking at the limit, we find this thing which is pretty ugly, but we find that. And that justifies this shape, which is not a straightforward shape. Right? So more generally, I think it's an interesting approach when you look at this kind of problems, which is that it's always, you're always tempted to use directly continuous time dynamics because of all the easiness and the tractability, right? But it's very often difficult to justify the shape of those dynamics. But if you already start from an intuitive discrete time dynamics and you look at the limit, it's much easier to justify. Yes, Stefan? Yeah, so phi is actually, yes, so I took a phi which is this one, this 2f. It's an example in the shape in the case of fire cells, but actually if you look at here, the derivatives of phi and f are very close up to a factor here, right? Because here you make derivatives with respect to z, so those terms disappear, so it's very close, right? So you can just kind of assume here that the phi is f up to a certain factor, right? So that's the steps for the proof, and yeah. So what's interesting here when we have the continuous time dynamics is that we have lots of things which are tractable, and one thing that we are interested in is how the dependencies between the assets move because of feedback, right? It's kind of a major issue because what's important is not that one asset behaves in a weird manner, it's that the whole market is completely disrupted by someone who is liquidating a diversified portfolio. The best way and easiest way to look at that, although it's not the perfect way, is to look at correlations, right? Of course, correlation is not a perfect way to capture dependencies, right? But it's let's say, the first order way. If you look at the correlation, the realized covariance here of the dynamics that I presented, you see that the realized covariance matrix is actually equal to a fundamental covariance matrix, so capital sigma. Remember, it's the one that we introduced in the beginning, which was the one representing the fundamental relationships between the assets, right? Plus all those terms in red. And if you look at those terms in red, you see that, well, first they are path dependent, right? So here is the instantaneous covariance. So if you look at the real covariance, it's going to be an integral of all those terms. So now in this model, in a very mechanical manner, covariances will depend on the path of the prices, right? They depend also on the liquidity of the assets, and liquidity is hidden in this vector capital lambda. Capital lambda is a ratio between the size of the fund's position and the liquidity of the asset. Right? So when capital lambda, when the liquidity is infinite, it means that the market depth D is equal to plus infinity. So capital lambda is actually equal to 0, right? So when capital lambda is equal to 0, you see those terms disappear, right? So it means that in an infinitely liquid market, well, all the terms in red disappear and everything behaves as fundamentals, right? That's not surprising. In a market where there are no rebalancing, f prime here and f prime here would be equal to 0 also. People don't do anything, right? They stay constant, right? And so there's no rebalancing either. And there's no effect either. What's interesting is when there is rebalancing at a certain rate, and the liquidity is not infinite. So when that happens, when this f prime is not equal to 0, and when the lambda is not negligible, it's not too close to 0. You see that there's an order 1 in lambda here, and an order 2 in lambda. Right? And actually what happens, and we've done some calibration of those parameters in empirical studies in the past, right? We see that in large fire sales episodes, actually this vector lambda is not negligible at all because people liquidate, funds liquidate something which is 20, 30% of the whole market depth. It's not negligible anymore, right? And the rate of sales is high, right? They don't take the time to do it properly over 2 months. They do it quickly over 1 week, right? So the impact is much higher, right? So here, as Stefan mentioned, I took one example, which is the example of fire sales, but you can just start back from the generic fee and get the result here. There's actually a few papers where we do that, right? And more interestingly, if you have one phi in mind, so one type of feedback to study in mind, you just use this function and input it. And what's interesting is that you can compute the results from this kind of formula, right? So what we see here is that even when we start with constant correlation, so homoscedastic inputs, by incorporating something which seems pretty natural, right? The fact that big players impact prices, you endogenously and in a straightforward manner end up with heteroscedasticity in the covariance structure. So in a very natural manner, by incorporating the fact that big players impact prices and react to prices, you make correlation path dependent, right? And it's not a complicated model of saying, okay, there's this factor, and then you integrate and everything. No, it's just that you have something which is very simple. You start with, let's say, Black and Scholes, and then you incorporate the fact that people react to a Black and Scholes because they hedge options or they liquidate stuff or something like that, and then you incorporate that, okay? And as I told you, of course, all those models are consistent with the models that we currently use because if you assume infinite liquidity, all those terms in red disappear, right? So they're just forgotten, right? All right. So that's for the covariance matrix, right? So let's look now at the effects in terms of contagion. So here I took the example of one fund which was liquidating a certain portfolio, right? And what's the impact for the other players in the market? Well, first, we can compute the impact for the fund itself. So what's the impact for the fund itself? You see that, so let's look at the impact in terms of volatility, in terms of, let's say, risk, right? So volatility. The volatility of the fund who is liquidating is equal to a fundamental volatility or variance here, plus those terms in red, which are, once again, a term of order 1 in additional variance and a term of order 2 in additional variance. And all those terms are positive, right? If you look into the detail, it's positive. So that means that, and that's of course very expected, because the fund is liquidating assets, it's going to endogenously increase its volatility. Right? And it's not something which comes outside, right? It's not an external impact. It's the fund itself which is generating that. So that's an endogenous risk that the fund is experiencing. Right? If you think about it, that's something that is very rarely taken into account when you build a portfolio. When you build a portfolio, right, and if you've taken any courses or if you've been teaching that, very often what we do is that we look at, well, the basic stuff would be, let's say we do a Markowitz type of allocation, right? And then if you want to go a bit further, you look a little bit at liquidity, but you never fully incorporate the fact that in very bad scenarios, you'll actually be forced to liquidate your portfolio. But actually, that's something which changes everything. If you build your portfolio by saying, okay, when things are normal, my volatility should be this, and so I'm going to pick this kind of assets, you're actually underestimating some tail scenarios, which would be that in some cases, when things go significantly bad, actually you're not just going to look at the market, which would be a fundamental market, but you're going to look at a market where you are forced to liquidate your assets, and you are going to force yourself to increase your volatility endogenously. Right? So this is actually something that you could use in a risk management framework just for stress testing your portfolio, right? if imagine you work in a portfolio management firm, right? And you end up with the portfolio, right? You can just stress the liquidation of this portfolio in the same way as you stress the volatilities or the returns of those portfolio, right? Usually people do that, right? You say, okay, if the volatility increases, what's the impact? But they don't do, okay, if I have to liquidate, what's the impact? They never do that. But that's actually one of the main concerns, because actually, if volatility increases and you start losing money, you'll be forced to liquidate. Right? What's nice here is that you have everything in tractable manner. All the parameters here, so your F is something that you know, because you know at which pace you will be forced to liquidate, and you know your positions alpha, and you can estimate the market depth in the market, so the liquidities of the asset. Although it's not that straightforward, you can have some kind of tools to try to estimate that. Right? So that's for the impact on the fund itself. If you look at, and actually, yeah, maybe to wrap up on that, the fund increases its own volatility endogenously, so that actually decreases the diversification effects, specifically in the bad scenarios, right? So I'm not saying it's bad to diversify, not at all, right? But you have to have in mind that in some cases, however well you are diversified, there will be scenarios where actually correlations spike, not because of an extreme market event, but because of your own behavior. Right? All right, now let's look at spillover effects. So what's spillover effect? What do I mean by spillover effect? I mean by the fact that you have this one fund which is liquidating stuff and which is actually going to impact other fund managers, other funds in the market. Right? So I'm looking here at a small fund, yeah, with position mu, right? And who is in this market? This fund is investing in the same kind of securities, and it turns out that another fund is liquidating assets. Right? So fund alpha is liquidating assets, and I'm fund mu, and I'm just there, and I'm just looking at what's happening. I actually don't even know that someone is liquidating, right? I just happen to hold the same assets. So if I look at the impact of those liquidations on my variance, on my risk, right? Let's say in terms of variance, I see that once again, I have the same kind of decomposition, and it's a tractable one, of a fundamental variance plus order 1 variance and order 2 variance.
But you're assuming that both of the funds have the same schedule of liquidation.
No, there's just one who is liquidating, right? So just one fund, alpha, who is liquidating, and the other one is some guy who is just there and just doesn't even know that there's liquidation, but sees its own variance move. Right? And what we see here is that you have an effect of fund alpha liquidating on the fund mu, right? And you see first, it's an indirect contagion, right? Because it's fund alpha is going to impact fund mu, not because they know each other and they have contracts between each other, right? It's not that. It's because they hold the same assets. So there's going to be a liquidation, a contagion effect, which will be price mediated. It's going to go through the prices, which are impacted by alpha and which are held by mu, right? So it's an indirect contagion, right? And this time, the shape of this indirect contagion is more subtle. If you look at that, the indirect contagion will depend on a factor, a scalar product here, lambda times pi mu, which I wrote here, which is kind of a scalar product of liquidated positions with respect, as a function of asset liquidity, times, or scalar product with the positions of fund mu. Right? So it's kind of the projection of fund mu's holdings on the liquidation vector. But it's not the simple liquidation vector. It's the liquidation vector which is weighted by the liquidity of the assets. Right? You see that if this scalar product is equal to 0, actually here the terms disappear. So although a big fund may be liquidating, I may have some positions which are such that I don't feel their liquidation. And typically, if you think about it, that's exactly what happened in this quant event that I was telling you about. In the quant event of 2007, there was a big fund, Alpha, which was long-short and which liquidated assets. But the market, the index, mu, has only ones, right? And the scalar product of that is very close to 0. The alphas will be positive and negative, and the mu's will be close to 1, 1, 1. And so the sum will be very close to 0. Right? So you see that the impact, the contagion from one fund to another is going to be, of course, dependent on how close the portfolios are. Right? So for example, if a fund liquidates, a big fund liquidates some assets, but the only assets that I hold in common are liquid assets, I don't care actually. Because when that fund liquidates lots of stuff, it's going to impact lots of stuff, but it's going to impact less the liquid assets. So if the intersection of both our portfolios are only those liquid assets, I don't really care. What I'm going to care about is if we hold the same illiquid assets. If I hold some illiquid assets and someone's liquidating them, the impact is going to be tremendous on my portfolio. Right? So it's actually the overlaps which are important, and it's an overlap also which has to take into account liquidity. Right? It's the liquidity factor is going to be very important here. All right. Something which is interesting is that, well, these kind of things happen, right, in the financial markets, and there's a lot of comments when these kind of things happen, and there's a lot of ways of saying that, of calling that, right? So there are people who call that black swans or extreme events or this kind of stuff. What I want to emphasize is that this can happen even without liquidity drying up. Right? You can have a market which functions in a very normal manner with the same kind of volumes or liquidity of presence of market makers making a proper market, and still have that happen. Right? This would be the case if someone is big enough to make prices move. In real, and actually you see that all the models that I did here assume a constant liquidity factor. Right? So even here in the models that we use, we don't stress the liquidity factor, the market depth. Right? In real life, very often things are even worse because in addition of people selling or people behaving in a cordon market, right? Also, sometimes liquidity evaporates. So the market depth D becomes much smaller once all of a sudden. Right? But what I'm telling is that everything that I'm talking about can happen even without that. Right? Actually, if you look at the effects after Lehman Brothers, we can't say that market depth was lower. It's actually bigger. There was much bigger volumes, right? And much bigger involvement of people on stocks. It's just that everyone was in the same direction, right? So it's very consistent with a constant market depth and a very large volumes of liquidations, right? All right. So that's for the results of the continuous time dynamics. So now what I'm going to do is to try to apply this kind of approach to risk measures. Right? All the approach that we did here was a very quant approach. So that can be used if you're in a fund, right? And you have a bit of technical knowledge and you say, okay, I know that I'm a fund and that I have this kind of holdings alpha, right? Or here alpha. And that in bad scenarios, I'm going to deleverage at a rate F prime. So I know that in bad scenarios, my volatility is not going to be this, but this thing. So what should I do? Right? Maybe I change my allocations to have more liquid stuff, or maybe just I buy a put option on very low strikes to hedge me against very, very extreme events. There's a lot of things that can be concluded from this kind of approach, right? But it's a very quant approach. So what we're going to do now is kind of be a bit intermediary and have just look at the consequence in a less quantitative approach, but just look at the risk measures, right? Which are monitored by kind of everyone in the market, right? And regulators and, of course, practitioners monitor that. So if we look at risk measures, So that's more recent work that I did so with Rama and also with George. If you look at the risk measures that we use, well, so typically value at risk or expected shortfall, right, which are the ones which are used by the regulator, right? So it's not that practitioners decided to use that, right? It's that it's imposed by the market that you have to use that, right? So now we're moving from value at risk to expected shortfall, but both are used, right? If you look at that, those risk measures, they essentially measure mark-to-market risk, right? And you look once again at the dynamic asset price dynamics, which would be once again given exogenously, and you look at what would happen, what's the loss, what's the mark-to-market loss. So you never take into account the potential effects of your own trading after a potential loss, right? And most of the cases, it's okay because most of the cases, you don't react, right, to a market shock. But in the worst cases, you'll have to react, right? If you're a bank, you'll have to react because of capital requirements. If you're a fund, you'll have to react because of investors taking their positions. Right? But if you think about a market, a risk measure like value at risk or expected shortfall, it gives you the loss in the 1% worst scenarios, right? But actually, in the 1% worst scenarios, it's typically the situation where you have to react. Right? It's typically going to be a case where you cannot just sit there and say, okay, I lost like, I don't know, 12% today. Okay, so be it. No, you're going to react, right? You're going to do something. And so those risk measures which are built so that they actually forget, it's not that they underestimate, they completely forget the fact that after a mark-to-market loss, and especially after an extreme mark-to-market loss, so typically the 1% most critical losses, you most likely have to react to that. Right? So what we're going to, so to put it simply, if you look at those risk measures, if you multiply the size of a portfolio by 100, the risk is multiplied by 100, right? This is how they're built, right? But intuitively, if I tell you, okay, if my portfolio is of size 100 million and has a value at risk of 2 million, and if I multiply my portfolio by 10, and now my portfolio is the size of 1 billion, no one would expect my value at risk to be 20 million, right? It should be much, much bigger, right? Because of liquidity, right? And actually, if you just use value at risk or expected shortfall, it is 20 million, right? It's something which scales linearly in the size of the portfolio, right? It's a homogeneous risk measure, right? All right. So to sum up, the risk measures, they focus on market risk, right? And what we wanted to emphasize is that there's not only market risk. Market risk is a big risk, but there's also liquidity and liquidation risk, right? And once again, the objective is not to say, okay, we forget about market risk and we just focus on liquidity risk, right? It's not that. It's that it should be not that complicated to just mix the two of them. So that's what we wanted to do with George in a very simplified manner, right? So we took a very simple example just to show how it behaves in a tractable manner, right? So let me skip that and show you the results. So let's come back to something which is simple. You look at something which has a one period, right? So assets begin at prices at time 0, and there's n assets. So S01 is the price of asset 1 at date 0, etc. And you have a fundamental return. So you forget about the drift, right? So there's no drift. There's here matrix A, which is the square root of the covariance matrix. So A times the transpose of A sigma, right? And so the return is this, right? So here we are actually in the Black-Scholes framework, right? You see, it's the Black-Scholes. Right? All right? So you start with the Black-Scholes framework, and then you look at a fund which has some holdings, right? So holdings delta of the funds, right? and which has a certain proportions of holding. So the fund has put, I don't know, 10% in asset 1, 20% in asset 2, etc. Right? All right, so that's how you build your portfolio. And if you look at so everything is Gaussian here, right? So it's very easy to calculate the value at risk and expected shortfall. So here you just go on Wikipedia and type that and you have the formulas if you don't know how to prove it. And so you see that the value at risk would be size of the fund, V in cash, right? Times the variance of the fund. So it's, times the volatility of the fund. So here the X is the allocation vector, right? So this is the volatility times a factor, right? Yeah, which depends on this on the confidence interval that you choose, right? So that's for the value at risk, and that's for the expected shortfall, right? You see here that with a formula like that, it scales linearly with respect to V, right? So it means that if you multiply the size by 1 million, the risk is multiplied by 1 million, right? So it's linear. All right, so that would be the fundamental value at risk and the fundamental expected shortfall. Now what we say is that, well, if you look at the fund, after a movement of the prices, right? So remember prices move like that, so A times psi, right? The fund loses this amount in percentage, right? And what we saw is that if it's too large, the fund liquidates, has to liquidate, right? And the loss will not be just this, right? So this is the loss in dollars, and this is the loss in percentage. The loss will not be this, but also this thing here, which would be due to liquidations from the fund. Right? And now, what we want to do is look at the loss of the fund, taking into account also this component. So we want to look at the value at risk and the expected shortfall in the case where the fund has to liquidate some assets, but take into account the feedback effect of those liquidations, right? And so what we see, so there are some cases, but what we see is that, so let's look at the second line, which is probably the most interesting one, is that the value at risk in this model where you take into account liquidations is actually equal to the fundamental value at risk plus this term here, this red term, which is actually quadratic term. So it's not anymore linear, right? It's quadratic. Actually here, the fact that it's quadratic depends very much on the fact that the price impact is linear, right? So you multiply something linear by the size, so it's quadratic, right? But that's our choice, but you could change the price impact and have another type of impact here, right? But what we see is that it's not anymore linear, right? It has to be sublinear, right? It's kind of very intuitive, saying that if you multiply a portfolio size by 100, the risk should be multiplied by more than 100. Yeah? Because you become kind of gigantic, right? And that's actually taken here into account. And in a very simple framework, right? It's all those factors here, they can be computed in a very easy manner. Right? So you see here that you start from your value at risk calculated with your sophisticated model, right? And then you add this. Right? So an application that we had discussed, for example, with George or Stéphane, would be, for example, for margin requirements in an exchange via a clearinghouse, right? So you know that when you trade through a CCP, you are asked to put some margin. So it's initial margin at the beginning of the day, and you have to put a little bit of variation margin as the day goes by, right? What's the initial margin that you have to put? The initial margin is something which is very close to an expected shortfall at a certain level of confidence, right? So now the 1% or 0.1% expected shortfall, you have to put it in cash in your account with the CCP, with the clearinghouse, right? But the thing is that this amount does not take into account this kind of stuff, right? This amount takes into account a lot of statistically sophisticated factors, right? So of course, a CCP will never just use Black-Scholes, right? They would look at very complex factors and try to make a proper calibration, but they will still miss, and that's actually something which is true, they don't do that, they will miss this liquidity factor. But they're not stupid, right? So they know there's a liquidity factor there, right? So what they do is that they kind of arbitrarily require an add-on for liquidity. But this add-on is completely arbitrary. The thing that would be interesting is have, maybe not as simple as a model as this one, but something which would take this approach to make this add-on less arbitrary, right? This add-on should depend on the fund's positions, on the liquidities, et cetera, et cetera. Here you have a very simple formula for a possible add-on for an initial margin, right? And it's completely computable. All right? All right. So maybe to conclude so that there's time for questions, yeah? So what's the conclusion for this mini course? So the thing that we wanted to do during that I wanted to do during this mini course was to first focus on one aspect of modeling that is not yet developed enough, and which is that current models of financial prices do not incorporate big players. Right? And once again, it's okay most of the time, but in some cases it's not okay, and it's specifically when it's not okay that it's important to take that into account. Right? And the thing that I wanted to do is not to say that existing models are not useful, because it's not true. Existing models are very well built and sophisticated, but the problem is that they miss one economic component, which is the fact that big players may impact prices. Right? So I kind of used on purpose very basic starting points: Black-Scholes, linear liquidity, full liquidations, proportional liquidations, et cetera, to get some results. But actually, anyone who is interested to apply this kind of approach could use their favorite model, not Black-Scholes, but Heston or V-short or anything, favorite liquidity model, favorite liquidation schedule model, et cetera, right? So it actually gives you a way of anticipating those effects, which are non-negligible effects. It can be anticipated in terms of, it can be useful in terms of portfolio allocation, but also after you've chosen your portfolio in terms of stress testing your portfolio to liquidity issues, right? And so what's important is to keep in mind, at least in my mind, to keep in mind that there's not just one component to risk, right? The thing that is very often taught is market risk, and it's very sexy to talk about market risk, and it's very important to talk about market risk because most of the times it's the one that matters, but there are lots of different components of risk which are there, and one of the main one, which is very often forgotten, is the liquidity component part, right? Very often people invest in securities without having a proper modeling for the liquidity or the liquidation issues that would arise due to those aspects, right? And what we do here is we show that it's not that complicated. It's very simple. You just use something linear, and you just have a first-order effect, right? But already looking at this first-order effect can actually completely change the picture of the risks that you have for a given institution, right? All right, I'm going to stop here. Thank you very much. And maybe there are questions or...
Any questions to the lecturer?
Go ahead, George.
No, my question is, you're basically at certain point using Black-Scholes as the model.
It's a starting point. Yeah.
Suppose you have some kind of fast mean reversion to, for example, volatility. Do you think that we could push this to
Yeah. It's actually yes. So George is asking if the model is linked to the initial choice of Black-Scholes or if we can put anything else. So actually here, let me come back to, yeah. So this matrix sigma here can be kind of anything. So you can start with a Heston, you can start with something which is state dependent, you can start with something which is mean reverting. But that would be, as long as it comes from exogenous factors, it's okay, right? And then the endogenous part will be the one in red. So that's okay. Actually, we did some proofs on that so that we can still have the proper convergence theorems. So that would still be okay. So the idea is to say, okay, you start with your favorite covariance matrix type, right? So it can be, I don't know, V-short or mean reversion or something like that. And you add to that those endogenous effects. Yes?
Just curious if you look into measures of market position, because practitioners are always trying to measure niche markets and position of players. And usually when you have big chunk of positioning on one side of the market, then you have those red tails and large deviations. And I get a sense that this could add something to your liquidity metric or the market depth parameter.
Oh, okay, all right. So,
Open interest or other measures of positioning.
yeah, so it's more about how we estimate the market depth, or yeah,
Something like a,
yeah. So
have a huge open interest in one position of the market and something happens, you're probably going to have a shut tail in the other.
it's true. So in all the things that I presented here, I've never told you how we measure market depth. So it's a very convenient way to avoid the question, but I couldn't. So there's a lot of controversy about how to estimate market depth. What I used is so there's a lot of different papers and a lot of ways of trying to measure market depth. So there are purely statistical approaches, which are not linked to what you did, to what you're suggesting, which is you look at some kind of measures of daily volumes divided by volatilities, which would give you a good ranking of market depth. That would be one start. We use stuff which are related to that. So there's a very famous paper by Kyle, and Obijaeva, which was actually initiated by Obijaeva, who did a lot of stuff on measuring the market depth as defined here of US equity stock, of US stocks, right? And we actually did some empirical, an empirical paper with this model, and the way we measured market depth is exactly the same way as they proposed. Right? Then there's more refined ways of measuring market depth, right? So people who do more high-frequency trading will know that there's more information on the trading book than just looking at daily prices, and they know better, in a better manner, how prices will be deformed, right? Will move due to orders, right? And then there's another way which would incorporate macro stuff to say, okay, how would it be modified because of positions of other players, which I've not heard of, but which would probably be interesting to do. The problem is that it's not that easy to know those kinds of positions, right? So it would be very arbitrary. So I understood that in Brazil, the regulator has kind of a lot of data on the positions of funds, but unfortunately, that's one of the only countries that has that. Right?
Okay.
Love regulation.
Yeah.
Any more questions? I actually have one, but a lot of your model depends on the phi, when you choose for phi. In your case, you choose this deleveraging schedule.
Yeah.
What else could you use?
So it actually, yeah, so here it's also conveniently used as a deleveraging schedule, but the phi can be anything. So you have to have some kind of smoothness of phi. So it has to fit the mathematical theorems, phi has to be twice differentiable continuously and blah, blah, blah. But you can have phi, which would be, for example, the hedging of a delta hedging of an options position, right? And that would give you a quantitative framework to explain stock pinning, right?
But there's no conditions on phi. For instance, that
Oh, no. Yeah, you can check that. Yeah, it's true. We never talk about, like, we do everything here under P, right? Under the historical probability.
Okay.
Everything here is done under historical probability. I'm not even looking at that. Yeah.
Okay, fine.
Yeah.
Okay.
So it's all realized covariances and everything. Yeah.
So, any further questions? Well, if not, let's thank once again.
Thank you.